Have you ever wondered why investments that promise a fixed return, like bonds, seem to react so strongly to something as broad and dynamic as inflation? Bond yields change due to inflation primarily because inflation erodes the purchasing power of the fixed future payments a bond provides. When the cost of living goes up, the fixed interest payments and principal repayment a bondholder receives are worth less in real terms, meaning they can buy fewer goods and services than originally anticipated. The core economic mechanism behind this is the preservation of real returns and the concept known as the Fisher effect. This principle states that the nominal interest rate on a bond is roughly equal to the sum of the real interest rate and the expected inflation rate. Therefore, when inflation expectations rise, investors demand a higher nominal yield to ensure their real return remains positive or at least comparable. If inflation is higher than expected, the real return on a bond can even become negative, making it a less attractive asset. This also reflects an increased opportunity cost for investors, as they could find better returns elsewhere if inflation is not compensated for in bond yields. In practice, this means that as investors anticipate or observe rising inflation, they become less willing to hold existing bonds that offer lower fixed interest rates. This decreased demand for older, lower-yielding bonds drives their market prices down. Since bond prices and yields move inversely, a drop in price translates into an increase in the bond's yield. Consequently, any new bonds issued must offer a higher coupon rate and yield to attract buyers in a market where inflation is perceived as a threat to real returns. This dynamic highlights the crucial distinction between nominal yield, which is the stated interest rate, and real yield, which adjusts for inflation to show the true purchasing power gained. Savvy market participants closely monitor inflation expectations because these forward-looking estimates are key drivers of how bond yields will adjust. Instruments like Treasury Inflation Protected Securities, or TIPS, are designed to explicitly adjust their principal based on inflation, offering a direct hedge against this erosion, while conventional bonds relying on market adjustments to yield to compensate. Ultimately, the adjustment of bond yields in response to inflation reflects the market's continuous effort to ensure that investors are adequately compensated for the time value of money and the loss of purchasing power. It is a constant negotiation between the certainty of fixed payments and the uncertainty of future price levels, ensuring that the real value of an investment is always considered.